Well, good morning or good afternoon, everyone, wherever you might be. And thank you for joining us for today's Fidelity Live Sustainable Investing webinar. My name is Katie Constance, and I'm the head of Sustainable Investing Client Engagement based in London. And it's my pleasure to be hosting today's session. Before we get started, just a couple of housekeeping points. Today's webinar will go for 45 minutes. And if you have any questions, you can submit them via the Q&A buttons in the Zoom portal. And thank you to everyone who has already submitted their questions. So turning now to today's discussion on the just transition, by which we mean achieving the transition from a high carbon to a low carbon economy in a manner which is fair for everyone. Just transition is one of Fidelity's key sustainability priorities, and we recently partnered with Coalition Greenwich by seeking the opinions of over 120 institutional and intermediary investors to provide a deep dive into this important matter. Today, we will explore in more detail just what is meant by a just transition, and we will delve into the survey findings. We'll also look at why this is such a critical issue and how we are working towards this at Fidelity. To share their insights today, I am joined by Jen Huitan, Fidelity's Chief Sustainability Officer, and Emily Goodall, Head of Stewardship for Europe, both based in London. Jen and Emily will present for around 20 minutes, and then we will open up for questions. And with that, Jen, I will hand over to you. Thank you.
Thanks very much, Katie, and good morning, good afternoon, everyone. Thank you so much for joining us. Maybe we can just kick off with the first slide. I think the intention here is to sort of set the scene for 5 to 10 minutes, give you a sense of the topic, and then we can have hopefully a very open and fruitful discussion. So I'll spend a little bit of time on this slide because I think it's important to lay out what we mean by a just transition, because actually one of our survey findings indicates that it is a very complex and fairly new topic and not particularly well understood. So I think the first thing to say is that it is now well understood that we need to decarbonize as rapidly as we can if we are going to stem the fallouts from climate change. The question now has become around how do we do this and what does a transition look like? And the concept of a just transition is really to ensure that the efforts that we undertake to decarbonize our economies do not end up leaving behind certain groups of individuals or communities whose livelihoods are dependent on fossil fuels or carbon intensive industries. And I think it's important to remember here that while the costs of climate change are really going to fall on those who are least able to afford to bear it and least responsible for causing it. And so really the just transition embeds a moral dimension to it, as well as an economic dimension. I won't talk so much about the moral side of things, but I think that's an important backdrop to remember for this discussion here, because I think the economic case is very much there. And the economic case, I think, is very much centered on the need to maintain the popular support for a net zero. We need to be able to ensure that the disadvantaged groups that are being affected adversely through the transition is found some way to address those impacts. And what are those impacts that we're talking about? So this slide goes through a simple framework for how to think about those impacts. So on the bottom side, you have, I guess, the micro impacts, the individual impacts at the employee level. So those stranded workers who may have livelihoods dependent on fossil fuel extraction or power generation. You have the impact of the community voices, towns, peoples that have societies that have been created around that type of economic activity. And that is primarily, when we think about engagement and stewardship at a corporate level, these are primarily the elements that we focus on. But then there's the macro element as well, which is that at a country level, there are the broader mechanisms that we need to think about, including the just transition economic partnerships, which you may have read about, that help to ensure that the different parts of the world bear appropriate levels of responsibility and shoulder the appropriate levels of cost for the decarbonization efforts ahead. And then finally, at the industry level, different industries are going to be winners and losers from this. This is already manifestly clear in sectors like utilities and autos. It will extend, as we will show in some of our examples, far beyond the obvious sectors. how do we ensure that we are balancing the costs of transition in a way that is fair? So maybe with that, I'll move on to the first slide, which is the results of our survey findings. If we could go to the next slide, please. So this is at a high level, who is actually aware, who has even heard of the term just transition? And so the survey suggests that only 42% of the investors that we asked had even heard of that. And you can see the breakdown. And I think one notable disparity is between Europe and Asia, where in Europe you have just under half of investors being familiar. In Asia, it's just under 1/3. And that, I think, is an important distinction, because the just transition is going to be particularly necessary for decarbonisation in Asia and the emerging markets, particularly given the reliance that many of those economies have on fossil fuels for future economic growth. And we'll talk a little bit about that with example in the future. And that's why we think there's a lot more work that needs to be done to raise awareness and focus on this topic. Next slide, please. I guess in tandem with the low level of awareness, there is also a lack of conviction among investors that we will actually be able to achieve the just transition. Again, interestingly, Asia is a bit more optimistic than Europe, but overall, there is a sense that this is going to be quite challenging for us to achieve. Decarbonisation itself is a challenging endeavor. We all know that, just economically and technologically. You're now layering on social considerations to that. It's not surprising to us that there is a degree of skepticism about our ability as a society to achieve this, necessary though it is. Next slide, please. And this is, of those then that are familiar with the just transition, the proportion of those that have or are already implementing a strategy. So as you can see, only approximately 1/3 of those who are familiar are beginning to develop a strategy around the need for a just transition. The good news here, I think, is that just over half of investors do consider these types of issues, E issues and S issues, as part of a broader approach to ESG. So while there may not be dedicated investment strategies yet, there is at least a desire to embed it into the way people are implementing ESG as a whole. Next slide, please. And these are some of the core reasons for having the impact on the just transition. And the top two reasons, I think, which is not particularly surprising, is to create a better impact on the environment and society. And really what that shows is the close linkages between these two factors when it comes to this topic. Next slide, please. And this is in terms of where investors see the biggest focus, the biggest attention. And you can see that investors generally believe that equities will play the biggest part of the role. And I think that is consistent with our belief that engagement and voting and working with companies using the levers of influence that we have is going to be fundamental to achieving, to moving companies into considering this topic more. And then I think the second is around private assets. And again, that doesn't particularly surprise us, given that the focus will probably be on renewable energy, on infrastructure build-outs, on less liquid forms of investments. Next slide, please. And this, I think, is one of the slides that I think is probably the most interesting for me. Why do people think that a just transition is going to be so difficult to achieve? And I think overall, what we're saying is that there are many different factors that are going to be involved. And some of these challenges, these barriers identified, we as an investment community need to find ways to overcome them or work in partnership to ensure that these issues are being addressed. I think very clearly, the first and foremost is the lack of a clear government policy around this. And I don't just mean where we live, but globally as well, in terms of that global cooperation using the COP mechanisms. You need that partnership with governments and regulation and policy to create the right enabling environment for companies to engage in the just transition. And so that stands out very clearly. And I think some of the other factors we also need to bear in mind. So clearly, we're in a potentially recessionary environment with higher interest rates, a higher rate of inflation that is causing focus to be pulled onto different topics, and that is taking away some of the attention that the climate change agenda would have had before. And that encompasses the broader geopolitical tensions that we're seeing. Overall, I think these are not these are useful guides for us to identify where we need to spend more time and attention to ensuring that the just transition is properly baked in. But they are not, I think, challenges of themselves. And I think the important final finding is that once investors are convinced around the achievability of a just transition, there is a view that the just transition will result in a positive impact to the risk return profile of investments over the long term. And I think that's the long-term anchoring that justifies the need and the focus that Fidelity has as a long-term investors in this topic. I'm going to hand over to Emily and for the next section on how we've implemented it in practice.
Thank you, Jen. Welcome, everybody. Good afternoon. Good morning, everyone. So to continue that focus, we wanted to bring the concept to life somewhat, given that there is, perhaps as we've seen there, less of a clear understanding on the concept. So we'll look at some examples that we've encountered here at Fidelity, but I wanted to quickly explain first, if you go on to the next slide, please, how we are integrating this into our own research analysis process and the investment process. And that informs, of course, also our engagement with issuers. So we produce ESG ratings, the analyst team does, for each issuer under their coverage. And those just transition considerations, such as those listed on this slide, you can see pulling out indicators from the environmental and social dimensions of our framework, are actively assessed during this process. Depending, of course, on the materiality to the company, and you can see that in the weighting column where you would have weightings depending on the company and the industry that it's operating in, to ensure that it is sort of proportional and material. So the insights that we derive from this process have got two use cases. First is integration into the investment process, and the second informs our engagement activities, which is the area that I focus on, whether that be led by analysts individually, and we think of these as our company-specific interactions, bottom-up, as you see on the title of the slide here, bottom-up research, or led by specialists from the sustainability team, where I sit, which can be typically thematic or what we might call more top-down engagements. And this process essentially produces, as you can see here, some flexible, actionable insights relevant for the portfolio managers in their investment decision-making processes. So I'm going to talk on to the next slide, please. In relation to our net zero strategy, about a specific thematic engagement that we have. And this relates to our plan as part of that net zero strategy to phase out thermal coal from our portfolios. The process is to be doing that by 2030 in OECD countries and by 2040 globally. So this is the just transition is a really important part of this process, therefore, as it typifies, I think, the challenges and the trade-offs relevant to the discussion. So when we were formulating this engagement, we've really tried to approach this challenge very thoughtfully. No one transition looks the same or different depending on the context, the region, the sector, the company. And there are some challenging trade-offs that we want to explore or illustrate in an example to follow. But actually understanding and considering that social context is really critical. It helps us to better understand the key drivers and barriers that have led to the current situation the company is facing. Because and it could be, in our view, we hope it would increase the likelihood of a constructive dialogue with multiple stakeholders, and therefore the chances of success here being a just transition in that phase out approach. So if we go on to the next slide, please. Wanted to share an example, one of the challenging examples we've had from a state-owned enterprise from Southeast Asia that's particularly dependent on thermal coal generation. Now, we're lead in this collaborative engagement alongside regional investors, and it's a good example of the challenges faced. So firstly, we have to put it in context of the country, the governmental mandate. The population in this instance needs and wants reliable electricity across the country, with free or heavily subsidised services to lower income or vulnerable groups. Now, this is going to be critical to the country's economic development, and ensuring that that transition is just, therefore, across all demographics is a political imperative. Now, this is not unique, of course, to Southeast Asia, but globally, as we've seen in recent weeks. This is one of the most important issues for the country's electorate in this instance, and therefore the government when it sets its energy policy. So how do we achieve this cheap, reliable power and clean energy agendas together? In this instance, grid interconnectivity between the island groups doesn't exist at this point in time and is going to take huge investments. There's a significant cost involved in this, as the systems are currently entirely separate. But connecting those different power systems will enable renewables to become a baseload power source more quickly, forcing coal plants to go to idle. Now, this is a really important step. It's not how many coal plants that you have, but how often they run. So to achieve this modernisation, the country will have to significantly invest in the workforce to build out and operate the new power system. So this is an opportunity, as we've seen in the transition for workers. But the jobs will be skilled. That can provide opportunities for decades to come for populations in the country, and the economic development that will continue to go with that upskilling and the energy demand. I think it's worth highlighting and pausing here that globally in the coal industry, there's an estimated 3 million jobs will be lost by 2030. Now, this is more than replaced by the 22 million anticipated through renewable energy transition. But at the moment, just 4% of workers globally live under policy regimes with policies that actually equip workers for change. That's involving investing in new opportunities and strengthening the coal-dependent communities, to the stranded communities and stranded workers comments that Jen made earlier. So all of this is going to cost. And a principal concern we have as investors is the cost of that financing, because if entities are not communicating effective transition plans to the market, well, the market must reward them, and otherwise these transitions will simply not be economic. And I've referenced there in the final pillar that there is challenging financing pathway, though JETPs may provide a path. We've had some setbacks at the G20 discussions, but there is all eyes on the COP coming this year to look at how we can actually look at that financing and the JETPs to accelerate the progress that they're making. So in light of that, we'll move on to talk to the next slide, please. I think this also demonstrates that the challenges at the enterprise level, and as Jen referred to earlier, cannot be looked at absent of the policy regime. And this brings us to our final slide around the system-wide efforts that we as investors can engage with alongside the bottom-up corporate engagement and the thematic engagement that I referred to there. So that transition requires collaboration across public sector, private sector, but also civil society. And I've given just 3 examples here of some system-wide efforts, as we call them, that we're involved in, where we can try and engage. So through those engagements with companies, we can help identify market barriers to the just transition. And this can inform the practical efforts we can make to influence through these different initiatives. So on the first one, in terms of proactive policy asks, beyond the commitment that I articulated that we've made to phase out unabated thermal coal, we are a member of the Powering Past Coal Alliance. Now, this is a coalition of national and subnational governments working together with the private sector and civil society as well to advance the transition to clean energy. And that has a set of principles that we as financial institutions sign up to, which includes things like encouraging others to take action and sharing expertise with other financial institutions, which actually I'll flip to the final one here on the right-hand side, links to our work with GFANS and the role that we have in the APAC financing the managed phase-out of coal-fired power plants, which is seeking to specifically address transition barriers, again, amongst working with other financial institutions and linking to government policy to address the transition barriers unique in that region. And that's led by a colleague of mine based out in Hong Kong. And then back to the middle. In addition to that, as you saw in the research that we've presented there, there isn't a huge amount of clarity on what just transition entails for investors. So Fidelity last year was a founding participant to the Just Transition Finance Challenge, inputting alongside 17 other investors to look at a set of criteria that were released and were publicly available as of this year that could underpin a just transition label for investment products. Now, this is a voluntary set of criteria, but it does give some guidance as to what could constitute on the product side a just transition product. And it covers 3 critical elements we've spoken to, obviously advancing climate and environmental action, improving socioeconomic distribution, and equity, and increasing community voice. So really bringing that stakeholder participation and community aspect into the thinking. Now, having started out tilted towards private assets, I think we're pleased to say that the criteria that's published can be applied across asset classes, which is really key given the research we shared earlier about 89% of investors believing that equities, for example, will play the most significant role. So this is something that can be applied in a public equity context as well. So those are just 3 examples. We have others as well where we're involved on this system-wide influencing alongside the corporate and thematic engagement that we are actively involved in. So with that, I'll pass back to Jen for our summary slide and look forward to your questions.
So I will go through the sort of key highlights quickly. I think the first is to say that, you know, this is clearly one of our core priorities. Our research indicates that really only 2 in 5 investors are aware of the just transition. But the good news is that once they've been informed, 91% of those believe that they will have a positive impact on risk return profiles in the long term. There is some interesting divergence around the impact over the short term, which we can talk about in the Q&A. But I think that's the core positive finding from that. I think the other thing to say is that as an active asset manager, we believe we have a key role to play in helping to promote this, and that starts with education, awareness, and engagement. And if I think about the value that just transition brings to us as a firm, I think about it in 2 main parts. I think about it in terms of the research that we do on companies, which Emily talked about, our ability to use the just transition concept to understand the credibility and the achievability of the targets that a company is telling us that they're doing. It's a way of understanding, in effect, has management thought about the practical implications of those targets, and for us to be able to measure that progress tangibly. And the second is around that corporate engagement piece. Clearly, no one engagement is going to be the same. No transition looks the same. The just transition is a way of framing our engagements with companies to have a ultimately more productive discussion by understanding and measuring some of the challenges that companies have and those that they face in different parts of the world in achieving transition. So I think with that, I'm looking forward to the questions.
Great. Thank you, Jen. So some very interesting findings there from the survey. And a question here, just I think on one of the first findings that you went through, Jen. So you mentioned there's a lack of conviction amongst investors that we will achieve a just transition. You did touch on this, but can we explore in a little more detail why investors are so skeptical of a just transition, please?
I think the first thing to say is that they're skeptical because a lot of them don't necessarily know about it. And to the extent they know about it, they're confused about the extent to which it can be measured, the extent to which it presents trade-offs in the short term. So one of the findings that we had was that although 91% of the investors surveyed believed that it had that positive impact over the long term, in the short term, actually, you had a fairly even split between those that believed it would have a cost, those that believe it would benefit, those that believe it would balance out. And actually, that's, I think, a very fair finding, because the reality is that the just transition is going to entail a series of trade-offs. It will, in the long term, lay the foundations for a sustainable transition, no pun intended. But in the short term, it will create tensions between different communities, between different objectives, between the pace of decarbonisation. I think we should be honest about that. I think we should reflect that. We aim to reflect those sorts of considerations when we speak to the companies that we invest in. And so I think there is a degree of skepticism around how this can be implemented in practice and the extent to which it presents opportunities for certain companies to slow down the pace of their transition, which is clearly not the intention here.
Thanks, Jen. And maybe just sticking with something you said there, sort of a related question. So investors are still grappling with how to achieve net zero, how they should be implementing their net zero target. So from a practical perspective, how should they be factoring a just transition into implementing their net zero ambitions? And can they reach net zero without a just transition? A big question.
Can you reach net zero without a just transition? I think there is a danger in treating emissions reductions as a purely intellectual exercise in reducing the intensity figure or reducing the absolute figure of emissions. The reality is that decarbonisation is going to make enormous changes to the structure of our economy and structure of our society, and there is going to be quite significant impacts on different individuals. And I think the just transition is a way of encapsulating these different things. So will we have a sustainable transition without a just transition? I don't think so, because I think we will have lost popular support and therefore the political and regulatory underpin for the transition long before that, if we haven't taken into account these broader social factors. In terms of how investors can use it, so as I say, I think in two ways. One, I think, is when you think about the credibility of the targets that companies are announcing, asking them about how they've considered the societal impacts of that, I think, is a great way of understanding whether or not they have really thought about the practical implementation of it. And actually, a lot of companies that are quite progressed on their transition ambitions are very keen to have that discussion with us, because it's not that they lack the will to decarbonize, it's that they face significant constraints within either their society, the need to maintain energy security, the need to maintain employment, the need to fulfill long-term contracts. There are structures in place that lock in the existing system of reliance on fossil fuels. This is one way of understanding whether or not management has been thinking carefully and thoughtfully about how to address these challenges. And the second, I think, is around that engagement piece that Emily talked about and our different teams. The reality is that, different trade-offs are going to present themselves differently over different timeframes in different parts of the world, whether those trade-offs are around economic development, community voice, or stranded employees, or so on. And so for us, a just transition increases the likelihood of us having a constructive dialogue with companies, and therefore a higher likelihood of success.
Thanks, Jen. Maybe Emily, just following on from something that Jen was saying there, a question here for you. So should corporates specifically be considering just transition targets within their broader net zero plans? And how many do you think from what you've seen are already doing this?
Well, thank you, Katie, for that. So in terms of how many have we seen that are already doing this? Obviously, with our thematic engagement on thermal coal, we're getting a good sense within that target group. But some it would be new to when we started introducing this concept. Others are sort of quite well advanced on this. I think it will be really interesting to see actually with the next Climate Action 100 Plus, with the beta testing they've had of the Just Transition Indicator for the last benchmark results of this would have been back to March 2022, showed actually relatively rapid progress within that specific cohort. Because when you looked at the March assessment, then moving through to the October assessment, you had 6% of that cohort scored a partial disclosure when they introduced the first beta indicator on this, and that went up to a third 6 months later. So you can see with the ask, and there's also, other changes in, I can't say that's purely down to that indicator, of course, that shift, but you can see a sort of quite rapid trajectory of increase in understanding and then commitments being made. It'll be really interesting to see actually if that's continued when we see the results of the updated assessment, which are going to come out next month, I believe. And this will include results of the new indicator, which is no longer in beta testing, but forms the full part of the benchmark now. And I think it's important to say there that that indicator is going to look at a company's commitment to just transition, also its just transition plan. So it's not a target as such to your question, but plans that need to cover elements like a company's commitment to retain, retrain, redeploy, compensate workers. And that ought to be accompanied by quantified KPIs to use to track progress. So maybe quite a target, but at least more substance certainly to the plan. So looking forward to seeing those results next month. Sorry.
Great, thank you. And maybe following on from that, talking about sort of the plans that you're looking for and through your approach to engagement. So how are you looking to measure progress and success when engaging with companies on a just transition?
Yeah, so the criteria that we had, I mentioned earlier from the Just Transition Finance Challenge, are quite useful in looking across the three core components. In our engagement, maybe I'll use that as an example, as it's an illustration, and we apply a similar approach in other engagements. But first of all, with the thermal coal engagement, we screen for exposure, identify then the specific assets, whether that's power plants, mining, infrastructure. We look at the coal supply chain. Then looking at assessing the phase-out status. So we talked about the importance of context Context being everything to the starting point of our engagement. So we have sort of buckets of our phase out status, where at the top end, that would be where we feel it is aligned to the 2030, 2040 phase out deadlines that I mentioned. Amber would be around expected to overshoot the target, and then sort of red, more concerning, as if they're developing new capacity. And depending on the starting point, we have a set of objectives that we would use to engage around based on that starting phase out status. And then we have a tracking of progress through the calls to action that we've made, whether they've been acknowledged or addressed by the company, and then actually whether that change is being addressed and we're satisfied with the progress. That enables us to track that progress over time. So the objectives are, we have a framework for that, but they are very specific to the company starting point, and are informed by both policy and disclosure milestones from the issuer in question.
Great, thank you, Emily. Jen, so a question here in relation to one of the findings you noted earlier, which is in relation to a disparity in views on just transition between European and Asia investors in terms of awareness of the issue. So clearly at very different stages when it comes to net zero and a just transition. How is this impacting Fidelity's approach, in particular in relation to how we're engaging with companies in these different regions?
So I think I made a comment at the very beginning, which I stand by, that the just transition is going to need to be particularly relevant in Asia, because the development path of Asia is and sort of by extension the emerging markets, because of the heavier reliance on those industries on economic growth and the need to balance developmental concerns with climate change concerns. And that speaks to we bake that in a couple of ways. So clearly we have different timelines for coal phase out based on those developmental considerations. And I think that's a fair way to do that. And that is also reflected in the IEA's net zero scenarios. The second, I think, is that when we engage with companies in these different markets, the barriers that come back to us are quite different. Emerging market companies, broadly generalizing, have less room to play in terms of setting out individual corporate strategies by nature of the roles that they play in those societies, by nature of the need for energy security and so on and so forth. They need to operate within the boundaries of a more defined national approach to energy production and extraction. I think that informs our views when it comes to engaging with different companies around what we think success should look like for company to company. And I think I made this point earlier, that no one transition is going to be the same as another. Different companies, different markets are going to be coming at it from different starting points. And I think we are intellectually comfortable with the idea that progress is not an ideal end state. Progress represents incremental improvement from where you were yesterday or 1 year ago or 2 years ago. And so kind of when we engage, it's that incremental improvement and progress that we want to focus on, rather than on sort of driving a sort of a bright line standard and saying that, you know, all companies should reach that. So I think when we think about the differences between EM and DM, we think about how we are able to thoughtfully apply different considerations to these engagements. That's also reflected in the structure of our stewardship teams, which are very much local. They're based in the individual markets where we invest in Australia, Japan, Hong Kong, Singapore, and of course Europe and UK as well.
Thanks, Jen. Maybe Emily, a question for you here. So lack of government policy has been identified as a top barrier to achieving a just transition. Let's explore sort of what you would like to see in this space to break down this barrier.
Yeah, so I think, I alluded to announcements the last couple of weeks from the UK and French government. I think there have been some successes, if we look actually specifically to the European Commission with the Just Transition mechanism, where you've had targeted support to fossil fuel reliant regions that are most affected. I think the challenges remain very much right now around supporting households to transition. I think this can be a key ask from investors into the next European Commission, if we look at Europe. One of the key challenges is skills gaps. talked about the need to transition and upskill workers. This could start earlier on, though, as well, outside of the workforce, including skills development at technical colleges, for example, such as through grants, loan reductions, while also at the same time supporting companies in the work, with its existing workers, looking at the existing workforce through tax breaks. But I think, if we look specifically to the UK's example, they remain key blockers on grid development, permitting renewable storage build out, all of which are going to require quite significant stakeholder community engagement. And that, if that's done badly and if you don't have the right policy signals, that presents a significant risk. But it can also be an opportunity if it's done well. And so those are some of the elements that we look like at the granular level when we're looking at company transitions, but clearly speak to the need for, as I mentioned earlier, these kind of system-wide efforts to engage with policymakers also.
Thanks, Emily. And then maybe just a question sort of on governance, so at investor company level, are you expecting to see more done there?
In behalf of investors, in terms of looking at the governance of this, well, if I interpret the question in that way, then the first shareholder resolution I think that we saw seeking just transition planning was filed just last year, 2022. So you see this is a relatively recent development. And back to the Climate Action 100 Plus example that I gave, there were at least 3 resolutions filed on this topic last year. So I think you are seeing increased focus from shareholders, certainly. But this is part of why we are doing this session, as well as part of the role here is to also highlight the importance of the just transition. To reiterate what Jen said earlier, I mean, just transition is a necessary condition of meeting the goals of the Paris Agreement, and it is our collective challenge to find a way to make that achievable. We certainly have a role as shareholders, whether that's as active investors, even passive investors, but across asset class, as you saw from the slide earlier. So it is key that we work together to find a way to move forward with this.
Great, thank you. And I think we've just got time for just one more question. So there's a question here on why Fidelity why we're referring to Fidelity as an active manager as opposed to just an asset manager, because this not suggests that passive asset managers have no responsibility when it comes to achieving a just transition. Jen, maybe I'll ask you that one.
No, I think all investors have a responsibility. I think when we talk about being an active and engaged manager, I think we're talking about what we as a firm can bring to this, which is our capabilities around research, and engagement, and our active management. But I think fundamentally, to achieve that just transition requires all parts of the investment community to be engaged on this issue. And beyond that, I think, as Emily has pointed out very, very well, this is not something that finance is going to be able to achieve by itself. And it needs collaboration from many different stakeholders in society, not least governments and regulators.
Thank you. And just one more final question, Jen, just for you before we wrap up. So just in relation to Fidelity and what's coming next on this topic, so with investor companies, will you be considering divestment if companies aren't on the right path when it comes to achieving a just transition?
Yeah. I think you can't rule out any option. I guess to answer, as part of that earlier question around active and passive, divestment is an option for active managers, and clearly not for passive. That said, I'm very much of the view that divestment represents a failure of our engagement. It means that we have not made progress. It means that we have not been successful, and so it is very much the tool of last resort. Part of our philosophy around engagement and sustainable investing in general is that you want to lean into the problem. You don't want to make someone else take responsibility for addressing that problem. And I think, when we think about going about our engagements, I think we want to remain invested in all parts of the economy, whether or not they are good or bad, because whether you like it or not, they are all economically necessary to some degree. The question is, what is our responsibility to ensure that these businesses are generating and creating longer term value for us shareholders, but also for their broader communities and society and employees around them. And I think that's where the concept of that just transition becomes very important for us, is as a way of having a framework to assess their progress on this topic.
Thank you. Plenty for everyone to think about on this very important topic. Well, thank you, Jen. Thank you, Emily. That brings us close to time. And on behalf of Fidelity, thank you everyone for joining us today. We do hope you've enjoyed today's session. A recording of today's session will be sent out shortly and will be available on Fidelity websites. And if you are interested in finding out more, or if you have any questions following today's webinar, please do get in touch with your usual Fidelity contact. When leaving the webinar today, you will be prompted to complete a very short feedback form, which we would really appreciate you completing, as your feedback is extremely important to us. And please also do look out for the invite to the next Fidelity Live Sustainable Investing webinar coming soon. Thank you once again and have a great day.